Welcome to the Deep Dive. Today we're digging into McCormick Co., Inc., that's MKC, and their Q3 2025 earnings call. It was what the street often calls a classic beat but trim situation.
Exactly. It's this interesting clash, right? MKC managed to beat expectations on revenue and adjusted earnings. Operationally, things look pretty solid.
But there's always a but.
There is always a but. The market really zeroed in on a pretty significant cut to their forward guidance. And this cut was almost entirely driven by, well, one major external headache.
Which led to the stock dropping pretty quickly, 2 to 4% right after the release?
Yeah, something like that. It really highlights the key question for you listening. How much does strong volume growth actually matter if these external factors like tariffs just keep eating away at the profits?
Okay, let's quickly run through that initial financial snapshot then.
Yeah.
The headline numbers, on their own, look pretty decent.
They did. Q3 adjusted EPS landed at 85 cents. That was just a tick above consensus, which was hovering around maybe 0.82 cents to 0.24.
And revenue wasn't bad either.
Nope. Revenue also nudged past expectations, came in at $1.72 billion. That's about 2.7% growth compared to last year. So, Mavis beat there too.
So the top line looks okay. They're selling stuff. The issue wasn't demand then.
Not really. The problem was more about the cost of selling that stuff. The big flag was the gross margin. It contracted quite a bit.
How much are we talking?
Roughly 120 to 130 basis points year over year. And remember, a basis point is just 0.01%, but that adds up fast.
That's a noticeable squeeze. Initially, management pointed to higher commodity costs plus ongoing investments in tech and marketing, which makes sense.
Right, necessary costs. But that margin pressure was really just the appetizer for the main course, which was the guidance cut. And that was all about tariffs.
The tariff situation. Okay, so let's talk about the guidance revision. How bad was it?
It was enough to make the market nervous. They had to pull down their full year 2025 outlook. Adjusted EPS is now expected between $3 and $3.05.
And before? What were they saying before?
Prior guidance was $3 over 3 cents to $3.08. So, shaving off a few cents at both ends of the range.
And you're saying the main driver, the villain in this story, is the whole trade war tariff environment.
Overwhelmingly, yes. The numbers they threw out for tariff exposure were, they were big.
How big?
Shockingly big, frankly. Their current projection for the gross tariff cost, just for the remainder of this fiscal year, FY25, is now around $70 million.
$70 million? Wow. How does that compare to what they thought before?
That's a huge jump. Just a few months ago, their estimate was $50 million. So that's an extra $20 million hit they weren't banking on just for the next few months.
Okay, wait. If that's just for the rest of this year, what does that mean on an annual basis if these trade conditions stick around? That must be what really worried people.
Exactly. If you annualize the current tariff rates, the total gross annualized exposure jumps to an estimated $140 million.
$140 million.
Yep. Their previous annualized guess was $90 million. So a $50 million jump in expected annual costs. Just to give you some context, $140 million. That's like roughly 20% of their typical quarterly operating income.
Okay, yeah. That is definitely not a rounding error. That's a major, major profitability headwind.
It's a structural shock, potentially. And because of this huge projected cost, McCormick now sees their full year FY25 gross margin being basically flat compared to last year.
Which is down from their previous guidance. They were hoping for flat to maybe even up 50 basis points before, weren't they?
Correct. So that hope for margin expansion this year is, gone. And this raises a really critical point for you to think about. For them to even hit that flat full-year margin target now, they need a really significant improvement, a big step up in profitability just in Q4.
Oh, so they need Q4 margins to be much better than Q1, Q2, or Q3 margins were.
Substantially better. And, we haven't seen that kind of sequential jump recently. Management insists it will happen, though, because their mitigation efforts are supposed to really kick into high gear in Q4.
Okay, mitigation. Let's talk about that. How exactly do you plan to absorb a $70 million hit this year and potentially $140 million next year without profits just collapsing?
They're banking on a three-pronged approach. First is their CCI program. That's their internal cost-saving productivity thing, continuous improvement.
Standard corporate efficiency drive. Got it.
Second, they're pushing hard on alternative sourcing, trying to find ways around the tariffs, basically, shifting supply chains.
Makes sense.
And third
is pricing, but they're calling it surgical pricing adjustments, specifically targeting the tariff impacts. And they said most of that won't even hit the market until Q4.
Surgical pricing. That sounds tricky. And I found it interesting. They explicitly said they want to lean more on CCI and sourcing than on just hiking prices everywhere.
Yeah, they're really trying to protect that volume momentum they've built up. But is that realistic? Can cost savings in sourcing really offset a potential $140 million annual hit? Pricing is usually the quickest way to recover costs like that.
And that's the heart of the debate analysts are having right now. It's a massive challenge. Can you implement these targeted price increases without killing the volume growth? It's a real tightrope walk.
They seem to be betting that the consumer demand trends are strong enough to handle it.
Pretty much. Which brings us nicely to the other side of the coin, that volume strength. Because honestly, that part of the story looks incredibly solid.
Yeah, tell us about that. Q3 was their fifth straight quarter of volume-led growth, right?
Fifth consecutive quarter. Consumer organic sales were up 3%, and that was almost entirely driven by volume, particularly in the Americas. They are executing really well on what they can control.
And management had some interesting points about why this volume is holding up, connecting it to consumer behavior shifts.
They did. They highlighted a few trends they see as pretty long-lasting. One, people are shopping more often but buying less each trip. Two, they're grabbing those larger pack sizes for value.
Check out the store effect.
Exactly. And three, critically, people are still cooking at home more often than pre-pandemic, trying to manage their overall food budgets. Spices and seasonings play right into that.
Plus, you have the underlying health and wellness trends still helping, right? People wanting high-protein, high-fiber claims on packaging.
Yep. That plays into their flavor solutions side, too, requiring their expertise.
So looking at the segments quickly, consumer division sounded strong across the board.
Yes, spices and seasonings good everywhere. They saw positive volume and share gains in key condiments, Frank's Red Hot, Cholula, even mustard.
And importantly, they're winning in those faster-growing channels, like e-commerce and club stores. You mentioned club stores.
Right. And that channel strength might explain something interesting. Why their reported volume growth looks maybe a bit stronger than some of the third-party U.S. scanner data you might see. They're likely gaining share in channels that scanner data doesn't fully capture.
The off-scanner win. Okay. What about flavor solutions, the business-to-business side?
That was a bit more muted. Organic sales up 1%, but volume and mix were basically flat. The strength there is in their more specialized, high-margin flavor products.
The technically insulated stuff.
Exactly. They are seeing continued growth with QSR's quick-service restaurants in the Americas and Asia-Pacific.
And they also mentioned doing more reformulation work for big CPG companies and private label.
Yeah, that's important defensive work, helping companies make products with natural colors, less sugar, less salt, that kind of thing. It makes McCormick a really sticky partner for those big players.
So operational execution looks good, especially on the consumer side, but it's just overshadowed by this huge external cost pressure.
Precisely. Which brings us to their big strategic move, the thing they're focusing on long term, increasing their stake in McCormick de Mexico.
Right. The joint venture, they're bumping their ownership up.
Yep. Raising their stake to 75%. It's going to cost about $750 million in cash. They expect that deal to close early next fiscal year, FY26.
And the plan is for it to be accretive, meaning it adds to earnings per share pretty quickly.
Yeah, they said accretive within the first year. This is really positioned as their main strategic play to get deeper into Latin America, which they see as having great long-term potential.
But there's a short-term snag there, too, isn't there, with the currency exchange rates?
Unfortunately, yes. Right now, the strong U.S. dollar versus the Mexican peso is actually hurting the reported income they get from that investment since it's currently unconsolidated. So short-term FX pain for potential long-term strategic gain.
Okay, so summing up the investor perspective, it's this stark divergence. You've got solid operational results, especially volume.
Right. Management is emphasizing the operational momentum.
But the market is just laser focused on the profit warning, and especially that big jump in tariff risk. The stock performance reflects that. NKC has really lagged the broader consumer staples sector, the XLP ETF.
Severely lagged. NKC's total return over the last year is down almost 16%, while the XLP is basically flat. That tells you the market is voting with its feet, prioritizing the margin risk over the volume story right now.
And analysts are stuck debating that core tension. Can they keep growing volume in 2026 if they're relying mostly on cost cuts and sourcing rather than pricing to offset those huge tariff costs?
That's the $1 million or maybe $140 million question.
And just quickly, on M&A, any hints of other deals?
Not really. Management stuck to their usual philosophy. focus on flavor and condiments globally for consumer, and on tech and taste capabilities for flavor solutions. They also explicitly said, look, right now we are all hands on deck just closing this McCormick de Mexico deal.
Makes sense. Probably wise not to get distracted with that tariff cloud hanging over them.
Good discipline, yeah.
Okay, before we wrap this up, it's time for our favorite segment. This is not financial advice. We take the core tension from the earnings call and pitch a, let's say, creative trade idea.
An outrageous but plausible one.
Exactly. So the tension here is crystal clear. Proven volume success clashing head-on with scary margin pressure from tariffs.
And our thesis is the market is maybe overreacting right now to that $70 million FY25 tariff hit. It's treating it like a permanent fixture and maybe overlooking the long-term value from the Mexico JV closing next year, plus that underlying demand strength.
So how could someone theoretically play that view, betting on the long-term over the short-term noise?
Okay, here's the idea. It's basically a volatility and time arbitrage play. You could consider selling short-dated, out-of-the-money put options on MKC.
Selling puts, meaning you collect premium now, betting the stock won't fall below a certain price in the near term.
Right. You capitalize on the currently elevated fear, which likely inflates that put premium. Then you take that premium you collected
And reinvest it.
and immediately use it to buy long-dated call options. Think like targeting an expiry way out in fiscal year 2027.
So using the near-term fear premium to fund a long-term bullish bet.
Exactly. You're betting that over the next couple of years, the Mexico JV gets integrated successfully, it becomes accretive as promised, and maybe, just maybe, these tariff and commodity cost pressures start to normalize somewhat.
Allowing margins to recover back towards more historical levels.
That's the bet. That strategic execution and maybe some macro normalization eventually win out over the current trade uncertainty that's hammering the stock price today.
Okay, that is definitely an outrageous but plausible trade structure, betting on management's long game against short-term geopolitical storms.
It captures the core tension perfectly, I think.
So let's bring it back home. What's the key takeaway for you, the listener, from McCormick's Q3? It's really a story of good operational work getting sideswiped by external factors.
Yeah. Solid execution, especially on volume, but a necessary and significant cut to the profit outlook because of forces largely outside their direct control, specifically those escalating tariffs.
And the final provocative thought we want to leave you mulling over is this. How much faith should you put in management's confidence that their mitigation toolbox, the cost cuts, the sourcing shifts, can really buffer that entire $140 million annualized tariff hit as they head into FY26?
Or, put another way, does their plan rely too much on being able to pass through surgical price increases later on, at a time when consumers might still be very price sensitive? Is the timing overly optimistic?
That's the crucial question to chew on as you do your own analysis. And need we say it again?
Always. This discussion was purely for informational and educational purposes.
It is absolutely not financial advice. Please do your own research.
Definitely check out the full details of the guidance, think about their strategy, and consider how durable that volume growth might be if costs keep rising.
Thanks for diving deep with us on McCormick. We'll catch you on the next one.